Hello, teacher. Welcome to our presentation. Today we're talking about the decision that we take it in the second part of the simulator. So let's start.
Okay, so in our first decision, what we did was we decided to make some adjustments in the prioritization of our segment. So we decided to increase the score of individual number one by 1 point so as not to overlook it. We also raised the average target score we wanted to focus on in order to reduce the risk of default because we saw in our results, on our previous decision results, that we had like a problem with that. So now we decided to change our strategy and focus a little bit more on a higher scoring. We also regarding product guarantees. What we did, it was simply decrease the score by 1 point in the credit cards and consumer categories for individuals one, and the other sections we keep it as they were from our previous decision. Okay, so now speaking about the company segment, we decided to increase the for small medium enterprises 1 point and reduce 1 point for large corporations, since small medium enterprises provide higher profitability, and we noticed that in our previous results, this approach worked really well for us. Now, regarding the average target rating we aim to reach or we wanna get as our customers, we decided to rise it for the same reason mentioned earlier in people's risk, mainly to reduce the risk of default. And finally, in terms of product guarantees for the companies, what we did was increase the score for small medium enterprises by 2 points in short-term financing and also by 2 points in long-term financing. So as for the rest, we decided to leave it and keep everything the same. And that's also part of our strategy. We wanted to focus a little more, make some changes and adjustments for small medium enterprises. Finally, for our risk decision methods, we assign to companies 29,000, and for individuals, we assign 31,000. So, like the previous round of decisions, we use our whole budget to invest on these two areas.
Okay, so in the section of assessing prices people, we need to increase the commission and the interest rate slightly because the market risk that they represented increase proportionality to the increase in the late payment rates. Therefore, those adjustments have to be made. Now, the liabilities in prices people is the same thing that the assess. We need to increase the parameters slightly because this segment become riskier. However, some parameters work the same in both sections as not to cause a negative impact.
Now we're going to talk about the business prices. For the actives part of the business prices, we again decided to just make small tweaks to each one of them, always prioritizing small and medium enterprises or businesses. All of these points we only increased 0.1 or 0.2 points on each one of them. And also in the passive business prices, we again with small tweaks, we think that this strategy is going to work by maintaining a really increase or decrease of these prices. Again, and in this one, we just decided to increase the points by 0.1 or 0.2.
Now, I'm going to talk about the marketing and brand. First of all, I want to talk about the strategic focus and the brand. As you can see, we are executing a fundamental strategic shift by sharply reducing the priority on the retail segment from 60% to 40%, and pivoting the main growth focus to corporate clients, that is 55%. This rotation indicates a push to exploit higher margin opportunities in the corporate sector. To fund this change, the corporate brand budget is reduced from 72,000 to 62,000, assuming the bank image is sufficiently strong and that capital should be allocated to direct tactical acquisition efforts. In the acquisition and retention expenditure, spending on client strictly aligns with the new 55-45 priority. There is a notable increase in corporate acquisition to 26,000 and a reinforcement of corporate retention, essential for growth in this sector. However, despite the lower priority for the retail segment, acquisition and retention spending for individuals also slightly increases. And referring to the promotion campaign budget, the retail segment introduced a defensive move with a new 6K allocation for 24-month deposits, securing long-term liquidity. And in the corporate segment, we can see that we decided to prioritize profitability and risk control. The bank reduces risk exposure by cutting the budget for long-term financing without collateral to 5.5K.
All right, when it comes to corporate structure, in the recent decisions related to multinational technology, the bank increased its investment in both areas to strengthen digital transformation and operational efficiency. The multi-channel budget rose from 40,000 to 46,000 with a higher allocation toward mobile banking and stable investments in the call center and online channels, showing our commitment to improve customer accessibility and experience across platforms. Meanwhile, the technology budget expanded from 54,000 to 60,000, reflecting our stronger focus on innovation. We also maintain a high share for security technology, actually being at 35%, while slightly reducing management systems to a 28%. At the end of this, we increased resources for central services to 15%, showing our effort to modernize infrastructure and ensure system rentability. When it comes to training, the total budget reached the 54,000 out of the 75,000, signaling a consistent emphasis on employee development. This reflects a balanced approach across different areas. The commercial training increased to 17,000, supporting sales and customer relationship growth. The management training rose to 18,000, highlighting the importance of leadership and strategic alignment. And the risk management training remained at 18,000, ensuring that the staff are well prepared for credit evaluations and effective risk control. Overall, these changes demonstrate our intentions to strengthen both its technological capabilities and human capital as key enablers of long-term competitiveness.
Okay, so for the project section, we choose those that could help us to improve the condition. That one that had the greatest impact was the improvements of offers and managed funds, which helped us to improve the bank solvency. On the other hand, we didn't decide on any marketing projects because they weren't as high priority in this section. As we can see, the first results that come from this period show an increase in solvency, efficiency, net result at the end of the period, and risk indices in the market, in addition to a slightly variation in the financial margin. In this other part of the result, we can observe a slight increase in late payment rate, probably as a result of the increase in interest of growth for both markets, where it can be seen as an increase of 0.4%. However, in this other part, we can observe a considerable decrease in credit costs in both markets. This could have been due to the decision established in the selection of projects that help us to improve the solvency of the company, perceiving lower risk in the loans guarantee, which allow us to offer more favorable credit conditions to our clients in future positions. Finally, we can conclude that the decisions made during this period were correct, as we managed to improve the solvency and efficiency of our operation, an indicator that had been deficient in these periods. Now we just need to review the results to make the next decisions. Thank you.